Hello and welcome to the December episode of First Look ETF. I'm Stephanie Stanton with ETF Guide, and we are so glad to see you again. Coming up on today's show, a new actively managed ETF could help investors maximize their dividend income without sacrificing growth. Plus, we'll tell you about another recently launched actively managed ETF that aims to beat the S&P 500 with a growth at a reasonable price approach. And finally, capital appreciation while limiting losses. We'll examine a new suite of ETFs with a unique tactical investing strategy. But first, to kick things off, we've got Maital Legum from the New York Stock Exchange with a look at the latest ETF launch activity. Maital, it is always great to see you again. How are things shaping up in December?
Well, great to see you and great to be here again. So if you've been following along all year, it should be no surprise that it's shaping up to be a record year for ETF activity. In the US, we've had now 3,842 listed ETFs with over $10 trillion in asset under management. We're tracking nearly $1 trillion in new cash flows to date. That's right, $1 trillion this year alone. We're on pace to finish the year strong, so I can't wait to see where we are on December 31st.
Yeah, a lot to celebrate indeed. You know, we've seen many important milestones achieved this year by the ETF industry. Among them, the 20-year anniversary of the gold shares, and that ticker is GLD, which made its debut on the New York Stock Exchange way back on November 18th of 2004. You know, a lot has changed since then, but what has GLD's innovation meant to the rest of the ETF marketplace?
No, GLD revolutionized the way individuals and institutional investors access the gold market by eliminating barriers like high entry costs and logistical challenges associated with buying physical gold. It made gold exposure accessible to small-scale investors. GLD's success demonstrated that ETFs could be used to provide exposure to physical commodities previously dominated by future contracts and direct ownerships. So by pioneering a physically backed structure, GLD validated the concept of ETFs holding tangible assets. We now have ETFs that back all sorts of physical assets such as silver and platinum. And of course, the most recent innovation in this space has been the rise of physically backed cryptocurrency ETFs that hold Bitcoin and Ether.
You know, it's hard to believe that we are winding down 2024. As we do so, what other ETF trends are you guys monitoring?
A lot of the same themes we have talked about all year continue to resonate as we near the end of the year. We have seen a lot of opportunity in active ETFs, with over 3/4 of all launches this year being actively managed. We are seeing strong demand for risk management strategies and income-generating ETFs. We haven't really talked much about equity ETFs this year. We have seen a lot of activity in funds that offer access to industries focused on AI, cybersecurity, and robotics and automation. So with ETFs tracking more strategies and more asset classes than ever, we continued on making access to information easily available for all. Go to etfcentral.com and catch up on the latest ETF news and trends and all that is happening here at the NYSE, the home of ETFs.
All right, we will leave it there. Maital, thank you so much for the update. We, of course, are looking very forward to Season 5 of First Look ETF in the new year ahead, wishing you all a very happy holiday. And just a quick reminder to watch First Look ETF on Apple TV, Amazon Fire TV, and Roku. Also, we simulcast First Look ETF on iTunes, Spotify, Amazon Music, and other major podcasting platforms, so be sure to check us out there. ETFs can be used individually as portfolio building blocks to meet investment goals, whether it's targeted exposure to global equities or exposure to physical assets like commodities. ETFs can offer flexibility and choice. Well, here to discuss a new suite of actively managed ETFs with a tactical approach is Eric Biegeleisen, Deputy CIO at 3Edge Asset Management. Hello, Eric. It's great to see you.
Likewise. Thank you for having me.
So before we talk about your firm's ETFs, can you share with us your firm's investment philosophy and approach?
Sure, yeah. 3Edge prides itself and is known in the industry for offering tactical, multi-asset class, diversified solutions to weather all kinds of market environments. Our quantitative approach dates back to the mid-90s when our founder and CIO, Stephen Co-CIO, created a predecessor firm that was ultimately acquired. 3Edge has a similar investment philosophy and many of the same principles of that firm. So there are three core beliefs that guide our investment philosophy and approach. The first, we believe markets are micro-efficient, but macro-inefficient. That is, we believe in some form of the efficient market hypothesis, but just to a point. We believe that within an asset class, there exists a good deal of efficiency. Individual equities and bonds are generally fairly priced. And so it's to consistently outperform by doing stock selection, we think is a difficult task. We believe there's a lot more inefficiency across asset class. So our focus is not necessarily on picking Microsoft versus NVIDIA. Rather, our focus is on making decisions regarding US equity investing versus international, or gold and hard assets, or fixed income. So a bigger, more macro picture, which lends itself nicely to using ETFs to build our solutions. They trade intraday, they're generally liquid, tax efficient, provide easy access to a wide variety of exposures, and they're low cost. Second, we determine how and when to tilt a portfolio towards or away certain macro asset classes by having constructed this model of the global capital markets that uses a nonlinear dynamic system framework. And really all this essentially boils down to is a system of cause and effect factors that may contain feedback, lags, and phase changes. Any individual factor is simple enough to comprehend, but putting them all together requires the use of a computer, hence that quantitative process. And then the third piece of our investment philosophy, we just believe that many investors underestimate risk, or more specifically, portfolio maximum drawdown, that is the worst peak to trough decline that a portfolio experiences. Most of modern portfolio theory is predicated on this belief that asset prices conform to a Gaussian or a bell curve, when we know mathematically that the number of large drawdown events that we've seen just in the last few decades should have happened over thousands of years. So that left tail of possible large negative return outcomes is much larger than a normal distribution would suggest. So we account for this in our analysis by placing real heavy emphasis on minimizing that portfolio drawdown in our construction process and our optimization processes.
So you guys have a dynamic ETF suite of 4 ETFs that are targeting these different asset classes, including among them stocks, fixed income. Tell us more about the investment strategy of these ETFs and break it down for us.
Sure. Yeah. So in the various seasons of the markets, we find equities tend to outperform in growth environments, hard assets like gold and commodities in a late growth or inflationary environment, short-term fixed income and rising rate and credit contraction conditions, and long-term fixed income, particularly treasuries, in a deflationary or depression type environment. And so it's for this reason that our tactical core multi-asset class solutions have exposure to all of these assets at all times. We built these 4 ETFs to allow investors to have the building blocks that we believe are necessary to provide a complete diversified multi-asset class offering, though they can certainly be used on their own as well. So the investor would really just go about choosing their desired level of risk in terms of volatility and acceptable level of maximum drawdown from a more conservative to a more growth-oriented solution, and we'll provide the allocations to these 4 ETFs on a continuing basis. Individuals and advisors can follow along with these model changes in a separately managed account, SMA, or they can let the technology do the work for them if they get access to our model solutions on a third-party asset management platform, a TAMP like InvestNet, Orion, SmartX. So going a little deeper here on each ticker, EDGU and EDGI are our 3-edge dynamic US and dynamic international equity tickers. These are all equity and tactical within. The US equity ticker, EDGU, will generally hold US equity sector exposures with slight tilts towards those areas likely to outperform, and funded from those we believe may underperform in the near term. We may invest in thematic, size, style, industry segments that we believe may outperform in the near term. And then similarly, that international ticker, EDGI, focuses on non-US investments that might include Europe, Japan, as well as emerging markets like China and India across size and style. The fund may utilize defined outcome or hedged exposures to reduce certain market betas at times and or currency exposures depending on our model research. Then you have the 3-edge dynamic fixed income ticker, that's EDGF. That's designed to invest across 2 dimensions, rates and credit. Our model research informs where on the credit dimension we should shift from treasuries to investment grade to high yield, as well as across that duration exposure from very short term, say 0 to 1 years, all the way up to 10-year duration exposure. And then we match this to hone in on specific investments. And finally, we have that 3-edge dynamic hard asset fund, EDGH, which may invest in gold and other precious metals, broad commodity exposures, specific commodity sectors like energy or agriculture, equity indices engaged in the production or distribution of commodities, and treasury inflation protected securities or TIPS. We think of this fund as like a liquid alternative that most investors would benefit from, having alongside traditional assets like equities and fixed income. The fund maintains a relatively large gold holding, which may act as a helpful hedge for future bouts of inflation, continued geopolitical conflicts and wars, and may continue to do well should global central bank demand for gold continue.
Yeah, I mean, you guys have a lot of bases covered. Quickly, just a few minutes left, then how do you see advisors and investors using the three-edge dynamic ETFs in a portfolio?
Yeah, so they're designed to be used together to build a globally diversified multi-asset class portfolio like we discussed. We think of them as these building block ETFs. They were created specifically to be used tactically to recreate our core multi-asset class solutions, what we call three-edge conservative, our more moderate three-edge total return, and our three-edge growth solutions in a more tax-efficient and widely accessible way. Our track record for these solutions goes back to 2016 for the conservative and the total return, and 2018 for the growth solution, and the version using these ETFs continues that same track record. By introducing these ETFs to build our existing solutions, we've been able to offer our investment solutions with a zero model manager fee on the third-party asset management platforms, those TAMPs, which we know advisors and their clients appreciate. All that said, we recognize for one reason or another, the full suite or tactical nature may not appeal to everyone out there, which is why we created these as building block ETFs as recognizable single asset classes, U.S. equity, international equity, fixed income, hard assets, such that they can be used individually on a standalone basis as a complement to other investments in the portfolio. Overall, the reception's been favorable, and we're excited to help advisors and their clients grow their assets in a risk-managed way with emphasis on protecting on the downside, but with the ability to still participate in rising markets as well.
All right, Eric, thank you so much for joining us here on First Look ETF. Keep up the good work. Dividend investors are trying to balance the need for income with the desire for growth, and a new ETF from Eventide Asset Management aims to help dividend-focused investors reach their goals. Well, here to explain is Dolores Bamford, CFA, Co-CIO at Eventide Asset Management. Dolores, it is great to have you here on First Look ETF.
It's great to be here.
So before we talk about the Eventide High Dividend ETF, and your ticker there is ELCV, what are some of the challenges facing dividend income investors?
We see challenges for dividend investors in finding an attractive dividend and strong risk-adjusted returns from investments that may not be aligned with their values. So there may be companies that have high dividends, but they're being generated from products and services that are causing harm to people, such as tobacco or alcohol, gambling, predatory lending, social media, abortion-related products, weaponry. Other companies may have practices and operations that are jeopardizing the health and safety of their employees and their communities. So all of these can be challenges to dividend income investors, along with concerns of the sustainability of the dividend.
So on that note, the Eventide High Dividend ETF, once again, that ticker, ELCV, is your firm's first ETF. So first of all, congrats on that. The fund is actively managed. Can you tell us more about the fund's dividend income strategy and then some of the holdings that we might expect to see?
ELCV is a unique and differentiated approach to dividend investing. First, it's aligned with Christian values, avoiding companies that are doing harm and contributing to suffering. Second, it's investing in companies that we're proud to own, run by good management teams that are performing well and paying attractive dividends, in our opinion, by doing good and serving others well. The companies are solutions providers and enablers to positive change. These companies are serving their customers and their stakeholders well. And companies that are producing products that are adding value to their customers and to the world as a whole. With a high quality, high dividend focus, we're also invested in important themes such as energy and power reliability, technology access and enablement, community banking, housing, health and safety, various types of security, clean air, and clean water.
Yeah, those all definitely sound like positive things to be investing in. So then on that note, how might this fund be used by financial advisors and investors inside a diversified portfolio?
We see this ETF used primarily for dividend income, as many investors, such as retirees, desire income from their investments and the ability to participate in investment growth that can only be achieved by dividend-paying equities as opposed to bonds and CDs. Also, this ETF enables investors to be exposed to large cap value, which has traditionally been challenging, as we just discussed, for ethical or values-based investors. ELCV offers a high integrity way for a person to invest in large cap value and to be proud of the companies that they own. And finally, this ETF enables investors to own quality dividend paying stocks within a diversified portfolio and diversifying away from some large cap growth companies such as large cap tech companies that have been overrepresented in many investors' portfolios. So high quality dividend payers have shown to offer some of the most attractive risk-adjusted returns.
Dolores Bamford, thank you for sharing more about ELCV, your firm's first ETF. We appreciate your time.
Thank you.
It is no secret the S&P 500's current valuation and PE ratio is high compared to historical averages. And that has some investors concerned and searching for reasonably priced stocks that still have upside potential. Well, here to discuss a recently launched ETF that uses this investment approach is Rob Haugen, Chief Investment Officer at River1 Asset Management. Hi, Rob. It is great to have you with us.
Thanks, Stephanie. Thanks for having me on.
So before we talk about the Trenchless Fund ETF, and that ticker is RVER, please familiarize our audience with River1 Asset Management's investment philosophy and approach.
Sure. River1 Asset Management was born just a year ago, and our single ETF that we run right now, its job is to beat the S&P 500. We concentrate in all capitalization stocks and essentially try to find the best 25 public equities that we think will beat the S&P or the NASDAQ or the market in general. And that is what River1 Asset Management as a company is attempting to do as well.
So the Trenchless Fund ETF is your firm's first ETF. So first of all, congratulations. The fund is actively managed and it aims to outperform the S&P 500. Tell us more about the fund's unique strategy and holdings.
Today's actually our 8-month anniversary. We started on the 3rd of April, and things are actually going quite well, especially lately. The fund is up just under 24% year to date, compared to 16 or 17% for the NASDAQ and the S&P. And what we've been able to do is we've been able to move within industry class, within market capitalization, and essentially find the best 15 to 20 stocks that we can find in the marketplace. And that what we do what we concentrate on in order to try to beat the market essentially is a couple of things. Obviously, fundamentals first and foremost. We're looking for companies that have great fundamentals and that are growing. Number two is we're looking for a valuation that makes sense, right? We don't want to overpay for anything or put anyone at a disadvantage as far as price goes. And then the third thing that we look at is holders. We're looking at essentially the risk reward of what we call holders risk or holders reward. And in that regard, what we want to see is we want to see money moving into a sector or into an asset class, essentially, or out of an asset class that we would avoid, essentially. And we try to quantify what that stock's ability to outperform the market will be based on where money is coming into the market or coming out of the market.
So how do you see investors and advisors using this fund ETF inside a diversified portfolio?
We have been, portfolio managers across the board for all asset classes for a long time now. And where we use it within our portfolios is what we call alpha generation, and that's attempting to beat the market. Now, there's a place obviously for bonds, for commodities, for stocks, and for what we call beta investments in public equities, essentially, right? That would be your S&P 500 or your NASDAQ, your Dow Jones, essentially. But not all public equity investments are probably suited to just tie the market, essentially, to buy beta or to buy the market portfolio. And so where River was started and why we started it is we saw an advantage in actually buying and selling stocks within an ETF in a short and medium term basis. We found we've done this for many, many years outside of the ETF, and we thought it was time to start an ETF, essentially, and show the world that this can be done. The market can be beat. And folks that are looking to invest and looking to not just tie the market in public equities, there is an asset class out there for that actively managed ETFs. There's a lot of advantages that we are able to rely on and essentially to hopefully beat the market over time.
And we are going to wrap it up there. Rob, thank you so much for your time today. We appreciate it.
Thanks, Stephanie. Thanks for having me on.
And that does it for today's episode of First Look ETF. We look forward to seeing you for season 5 beginning in January. So how have you enjoyed this season of the show? We want to hear from you. So give us your feedback in the comment section below and by hitting the like button. A big thanks to all of our guests, along with Maital Legum at the New York Stock Exchange. Be sure to check out etfcentral.com to learn more. I'm Stephanie Stanton with ETF Guide. Thank you so much for watching. We'll see you next time.